Hello everybody. So one of the things I do on this channel is I have a screener and I try to find the quote-unquote perfect stock for what I'm looking for. And this is an extract of the stocks that I have in my spreadsheet on Patreon, more than 100 stocks. And I try to analyze, I input everything, and I really try to find the perfect stock. And this is as good as it's going to get, at least for today and the research I did today. I'm leaning towards a few stocks in there that I want to allocate capital to. Before I talk about them, let me tell you what would be quote unquote the perfect stock, or the way I call it, the highest growth, but also a cash machine. I want high growth and I want a cash machine, and maybe I want to have a deal. Maybe I don't want to feel like I'm overpaying, right? Part of the reason why I'm not allocating too much to HIMS, because HIMS is up 197% over the past year. And so I want to take it easy a little bit because it ran a lot, right? So what am I looking for? I'm looking for high revenue growth, ideally twice the debasement. So what do I mean by that? Why do I want twice the debasement? Because if you grow revenue 15% over debasement, i.e. grow revenue at more than 30% a year, don't forget this channel is called Beat the Denominator, because the dollar is getting printed. I believe the dollar is getting printed at a rate of about 15% each year, which means that companies that don't take in more than 15% of revenue each year, they are not staying afloat. They are drowning, right? If you catch in 15% more, your stock theoretically is going to stay the same size. But to grow the company, to grow the stock, you got to catch more than 15% of these new dollars that are being issued. And ideally for me, it's 30%. Why 30%? Because 30 minus 15 equals 15. 15% per year over 5 years equals a doubling in real terms of the revenue over a 5-year period. So that's why I want high revenue growth, and I call myself a growth snob, and I'm upset when companies don't reach the 30%. The stocks I've selected for you here, they're all projected to grow their sales at more than 30% over the next 12 months. Now, what's another thing that I want? And this is partially to sustain that growth, to sustain that 30+% growth, for them to be able to invest in things like promotion, new product, on one hand, but also maybe share buybacks on the other hand, some form of capital return, or outright anti-fragility, right? If you have a very large balance sheet and you have a lot of cash on the balance sheet, you're more anti-fragile, you're less prone to market movements. So for that, I want the company to have cash machine features. And what do I mean by cash machine features is how much money are you bringing in each year after your operating expenses, and that's the EBITDA margin. And of course, I take EBITDA margin as a proxy for cash flow, because as many of you know, in accounting, there's a bunch of phantom expenses like depreciation, like amortization, and so I want to add those back because those expenses do not exist, right? If you take residential real estate, you're supposed to depreciate a house, for example, over 27.5 years. We know houses last longer than that. There's plenty of companies with machinery that has been around for much longer than, say, 5-10 years, right? So that's why I use EBITDA. I prefer EBITDA. Sorry, Warren Buffett and Charlie Munger, who call it BS earnings. And then the last one, of course, is I want to have a rule of 40, which I'm going to have. Obviously, if I get a 30% of growth, and if I get some high, quote unquote, high EBITDA, I'm gonna get the rule of 40. But ideally, I want a high rule of 40, right? And you can see they're all high rule of 40. I have some high rule of 40s here in the 70s even, right? 69, 70, so pretty high rule of 40. And this would be the ideal stock. So let me just go through a spreadsheet really quick. I have 52-week performance, and this is purely psychological, but it's enjoyable sometimes to not pay 197% more than a year ago for a stock, right? And so there are stocks that I see interesting here. For example, E.l.f, the makeup company, or Tidewater, which is an oil services company. They own a lot of large ships. I like the fact that these stocks are not trading way up for the year. I like that they're roughly flat for the year. I use enterprise value on this channel. I don't use market cap. I've added market cap because a lot of my viewers have requested it. I've also added stock price for my viewers because a lot of my viewers like to see the stock price and know when I make these videos. But know that for me, enterprise value is the right metrics to assess the cost of a company. I want to buy at an enterprise value that is low as far as a multiple goes, and this enterprise value, of course, is ratioed against the multiple, and you can see that some enterprise value, for example, if you're trading at less than 1 time forward revenue for LifeMD at a 0.78, you're pretty cheap. SMCI, you're pretty cheap. Luckin Coffee, you're pretty cheap. HIMS, Pinduoduo, you're cheap too, but in fact, these are all cheap stocks, right? I've selected them because they're cheap. They will all look cheap. To give you an idea of a stock, for example, that I would not select for a spreadsheet, would be a stock like Palantir. Palantir is trading at 30 times sales. So if you had Palantir here, you would have about a 30, right? So all of these stocks are at least 1 order of magnitude cheaper than a Palantir. For some of them, I don't have quite 2 orders of magnitude, but at least I have a few 40 or 50x cheaper than Palantir on that metric alone. And if you look at my enterprise value over gross profit, again, they're all pretty cheap. Why do I love gross profit a lot on this channel? I love gross profit a lot on the channel because, of course, there's things that you spend in operating expenses that the old industrial world would consider an expense, but that in many cases I consider an investment. Like if I'm investing in fixing my churn rate, if I'm investing in my reputation, if I'm investing in certain parts of my R&D, yeah, it's supposedly an expense in the old legacy ancient company type world. Yeah, it's an expense, but in the modern day, I can argue a lot of expenses that I see in operating expenses, I could argue, are really not operating expenses. They're really investments. Nonetheless, I still use EBITDA margin as a proxy for cash flow. I use gross profit as a proxy for let's call it a weak form of profitability is how I'm going to call it, a weak form of profitability. And then EV over adjusted EBITDA, and of course, this, in my view, is much better than, say, price to earnings. Price to earnings, ancient metrics, earnings can be manipulated. Price doesn't take into account that. I much prefer EV over adjusted EBITDA when I compare my stocks. And let me conclude with, so EBIT margin, I mentioned, but also that's a cash flow, right? The proxy for cash flow. And then my deciding factors here would be enterprise value over gross profit over revenue growth. And this asks the question, how much am I paying for each percentage point of future growth? What is the cost of that future growth? And the lowest the number, the better. And you can see in this stock between LifeMD and HIMS, I have the 2 cheapest stock out of 123 stocks that I hand selected for growth. These are the cheapest. LifeMD and HIMS, they're the cheapest. Telemedicine is the cheapest, essentially. Okay, and they still achieve a Rule-of-40. They all achieve a Rule-of-40 quite a bit, with some of them having outstanding number. SMCI, obviously, Pinduoduo, we'll get into Pinduoduo in a second, very good numbers. But anything above 40, the VCs typically, in the startup world, VCs will salivate when they see a 40. Think about, say, a Pinduoduo at a rule of 86, right? So it's quite stunning. In my view, none of these companies lose money. I find them all quite compelling. I own many of them. I don't own Chinese stocks right now, but I can tell you that when I see Pinduoduo, it makes me want to revisit my idea of not owning Chinese stocks. I don't own E.l.f. right now. I don't own LifeMD right now. I don't own Tidewater right now. I own all of the other ones. So let me just walk us through each of these stocks. So the first one is LifeMD. I've covered LifeMD actually more than a year ago now. LifeMD is a little bit similar to HIMS, except they don't have a pharmacy. They give you a discount, they give you a coupon. LifeMD is just the e-doctor, just the e-visit, and then they send that prescription into a local pharmacy. And they, of course, deal with minor issues, minor health issues, just like HIMSS. I would argue they also deal with what I'm going to call medium type health issues, because LifeMD, for example, they have a partnership with labs where you can get lab tests, etc., etc. But it's part of a thesis of a digitalization of healthcare and of the e-doctor, the digital doctor, the doctor in your phone, the consult in your phone. LifeMD is able to do this through partnerships with the real-world physical pharmacies, physical labs. I mean, labs are always physicals, right? Physical, right? But for that reason, they're growing lower in my view. That's the reason, because they are not fulfilling the drugs. They are not making a profit on actually prescribing the drug, and the prescription drugs are, of course, where a lot of money is made, and nonetheless extremely cheap stock, twice as cheap as HIMSS, but I think it's justified because, like I said, it's LifeMD is kind of like HIMSS, but it's half the story of HIMSS. HIMSS is the full story. HIMSS is rethinking, in my view, how we do healthcare. HIMSS is an app, as I like to call HIMSS. It's a digital doctor, an e-doctor, plus a digital pharmacy, an e-pharmacy, without insurance, because insurance makes pricing much more complicated. You know, these companies, they gotta reimburse to get the reimbursement for whatever consultation they have. It's a bloated system when you deal with insurance, and that's why HIMSS, but LifeMD is the same case. HIMSS is able oftentimes to offer treatment for minor health concerns for what I'm going to call cheaper than copays, quote unquote cheaper than copays, and that's how I call it. And of course, the chief advantage of whether it's a HIMSS or a LifeMD when you have a digital doctor is that you don't have to wait for, say, a few months to see a doctor. This is very important in unattractive areas where not a lot of doctors want to live. In rural areas, this is important. Also, sometimes you may see a family doctor, or, you know, a generalist and internal medicine doctor, and let's say HIMSS, for example, they do ED drugs, right? Not all mainstream doctors are going to prescribe those, are going to be familiar with those. So what may happen if you go get, say, ED drug for an ED treatment is you book an appointment with an internal medicine doctor, they check you out, they say, okay, yeah, all right, sure, but I'm not too sure about your case, and then they may refer you to a urologist, right? HIMSS kind of bypasses that because it allows you to see people who are specialized already in whatever medicine you're looking to get, in whatever ailments you're looking to get treated, right? And I want to point out too, for LifeMD or HIMSS, these are highly regulated businesses, so when you apply and you say, oh, maybe I'm eligible for an anxiety drug, it's important to note you don't always get it. You don't always get it. And I've been listening to calls from these companies, especially HIMSS, for a long time. You don't always get it. And if HIMSS doesn't prescribe to you, what they'll do is they'll refer you to a local hospital, local health system to look at your case, because obviously these are businesses where there's liability. If they prescribe something for you and, you know, they shouldn't because of something you say during the visit, they're not going to prescribe it for you. And important point to make, sorry about the tangent, it's an important point to make, because sometimes some people will say, oh, these are pill mills, these are type of businesses that are operating outside of the control, outside of a regulation, outside of a board. No, these businesses have real doctors, real nurse practitioners, real PA, real providers who can help with the problems. And I think that's why it's such a powerful offering. Note that both of these companies are growing pretty fast, especially HIMSS predicted to grow next 12 months at 53%, LifeMD 35%. That delta I explained with a lack of pharmacy for LifeMD, because if you don't have the pharmacy, you don't have a recurring business, right? That's kind of a problem, I would argue. Now, moving on to Luckin Coffee. Luckin Coffee. See, I'm going to get a lot of comments for this video, both on Luckin Coffee and SMCI. I don't own Luckin Coffee. I own SMCI, but people are going to tell me, oh, I don't want to ever invest in companies that have had issues with their accounting. And Luckin Coffee, of course, fixed it. They had issues with their accounting, which is why this stock was way down back in the craze of the early 2020s. that issue is behind them now, and now we need to get I would argue we get to focus back on the business model and back on the fact that Luckin Coffee is winning in China against Starbucks. They have close to 20,000 locations over there at Luckin Coffee, and it's a popular brand in China, and they just started their international expansion. They just went to Singapore, and sure enough, you may tell me, I may tell myself, I don't really want to invest in a Chinese coffee chain. That's weird. Maybe one could say that, but the truth is that it's very, very, very cheap. It's dirt cheap. It is cheaper than Hims. Actually, I made a mistake earlier when I told you Hims and LifeMD are cheapest. I see at the end of today, the valuation of Luckin Coffee make it so that it's now slightly cheaper than Hims. Look at that. Slightly cheaper than Hims. And I think that's got a lot to do with the fact that the Chinese equities are still heavily undervalued. And Luckin Coffee, on top of that, you still have the stigma associated with that accounting problem. But, if you didn't have that, the stock would be much more expensive. This is the same point I'm going to make about SMCI. If you didn't have the short seller accusing SMCI of a few things, which I have no idea what's going on. I don't know. If you didn't have that doubt that was casted by someone, whether it's for Luckin Coffee or for SMCI, the stock would be so much more expensive, so much more expensive. So uncertainty, you can diversify uncertainty at the portfolio level by having a bunch of investments where you have no doubts. Well, you should always have some doubts, but you can mix. No financial advice, of course, but me, that's what I do. I mix investments that I have full confidence in, that I'm not worried about, not even a little bit, right? Pure Bitcoin in a cold wallet. I consider this my safest investment. I don't have a single worry about that. And then I don't have a problem sprinkling in a little SMCI in the portfolio and taking the risk, because the other day, SMCI dropped 15% on the DOJ investigation, and I was like, well, I guess 0.1% of a portfolio is gone. Not a big deal, is it? Right? So it's about position sizing. I'm very much against going all in. I take forever to build positions, and I think that protects me from risk. And if I were to ever invest in Luckin Coffee, I still have to do a full due diligence. If I were to ever pick Luckin Coffee, right now I'm not leaning towards that. But if I were to, I guarantee you it will be a small position. And Pinduoduo is the same thing. Pinduoduo is a cheap stock because there are a lot of chatter about Temu and about Temu selling low quality products in Europe, low quality products in the USA, talks about banning Temu. Pinduoduo, by the way, if you don't know, they own Temu. Temu is a hit in Europe, it's a hit in the United States, and they're doing very well in China with the Pinduoduo app. Pinduoduo means shop, friends, fun, shop for fun with your friends. It's kind of how I would translate it. I don't speak Chinese, obviously, but from what I've read. So shop with your friends for fun, i.e. they're not trying to sell you a quality product. They are not, they're selling bare minimum products. They're not trying to sell you a high quality printed mug with a nice definition on the print on the mug. They're just selling you a mug. That's what they're doing, because you don't buy the mug because you need the coffee mug or the coffee cup or whatever. No, you buy it because shop, friends, fun. Fun shopping with friends. That's kind of a reinvention of a digital mall. And this has caught on in Asia, and sure enough, if you go to some of the Chinese websites, if you pull them up, you'll find them all about gamification. You spin the wheel, you get 15% off because you just spin the wheel. Oh, if you order within the next 3 minutes, you're going to get another 5% off. It's the gamification of shopping. The product, I would argue, is secondary. Enough about the business model. It's kind of less relevant. I wouldn't be talking about Pinduoduo if the valuation was a 1. If Pinduoduo was 10 times more expensive than it is today, I wouldn't be talking about it. I'm talking about Pinduoduo because I think it's a decent business model within the trends, but it has a very cheap valuation. How much am I paying for the growth at Pinduoduo? Under 0.1, 0.01. That is in the top 10% cheapest of stock I cover. And the rule of 40 is at 86. That's my highest rule of 40 of them all. Look at this gross margin. The gross margin is 62%. Why? Because what do they really sell? They sell a fun shopping experience. They don't necessarily sell stuff. They sell a fun shopping experience at a cheap price. And I think they have their niche cornered in the market. And I think it's a cheap stock. Moving on to SMCI. Oh gosh, people tell me, oh, don't buy SMCI. You shouldn't touch SMCI. As I've noted, I've controlled for this through the position sizing. In my view, it's just a very small position for me. And you know what? If I end up losing it at a 90% loss, well, that's okay. That wouldn't be the first time that I've lost money on a stock. It's part of the game, right? The point is it's cheap. SMCI is cheap. It's 0.2 on the EV over GP over RG. How much am I paying for that growth at SMCI? I'm paying something dirt cheap. The rule of 40 is very high at 73. And again, they are going to grow in unison with Blackwell. The demand for NVIDIA's Blackwell is enormous. Blackwell needs liquid cooling. Who has and this is what the CEO said in the last investor letter, who has a effectively 75% market share in large-scale data center liquid cooling? Who has that? It's SMCI. The thesis is that simple. The company is 11 minutes away. The headquarters of SMCI is 11 minutes away from the headquarters of NVIDIA. They've been working together for decades. They're both from Taiwan. Actually, Jensen Huang and Charles Young, the founder of NVIDIA, they both were in Taiwan from towns that are 40 minutes away in Taiwan. You can't make this stuff up. It's the supplier. It's one of the chief suppliers of NVIDIA. And if you go for the product catalog, you look at the product catalog at NVIDIA for Blackwell, you can see what they suggest you pair it with. And you see SMCI everywhere as you go through the catalog. SMCI is listed everywhere. So as Blackwell ramps up, as more of these next-gen GPUs are sold, I believe SMCI will sell a lot of stuff. And we'll see if there is accounting problems or not. We'll see if there is fraud problems or not. Some short seller alleged that it was happening. I have no idea. My point is there will be an investigation. And if there's an investigation, there will be a fine. And the law is going to do its job, but the law is going to do the job at the pace of law. And for all you know, there's nothing. For all you know, there's nothing. Remember, the short sellers, they write this stuff because they want the stock to go down. And in the case of SMCI, they were very successful at making the stock goes down. So if there's a fine, how many years do you think that's going to take? AI is happening right now. Blackwell is happening in 2 to 3 months. So that's my take on it, and that's why I like SMCI very much. I'm building the position. A full position for me is MercadoLibre, Meli. So Meli, I was lucky. It's a recent position. I remember when it hit $600-700 a shares. That's when I was buying it. They should probably do a stock split, by the way. A lot of investors, especially newer investors, Gen Z investors, when they see $2,000, they think, oh gosh, I've missed out. It's entirely psychological. Unfortunately, that's the way it works. It's the same price, right? But SMCI just did a stock split. They did it right. They probably should do a stock split. I would argue just for people to access their options too, because anyway. The point is. The stock has run 63% this year, so I guess quite a bit. But they're still predicted to grow, and they still have great numbers. Albeit it's the most expensive stock in my list, it is also the Amazon of Latin America, with a fintech without an AWS, as I described MercadoLibre. It's the business of Amazon, and so they have advertising, they have shipping, they have a leading marketplace without AWS, but with a fintech. It's kind of a distinction, and it's actually it's actually almost an idiosyncrasy. I mean, I feel bad because Amazon is the biggest player, right? So it's actually interesting that Amazon doesn't have an e-payments business, doesn't have a fintech business, and I guess because Amazon got started in the West where that fintech was already in place, quote unquote fintech, right? MercadoLibre has a fintech, and if you go to businesses in that area, right, in Asia, you have C Limited as a fintech. Of course, Alibaba has Alipay, that's a fintech. Of course, you go to Coupang, there's a fintech in Korea associated with that. MercadoLibre is the one that doesn't have Amazon is the one that doesn't have a fintech. MercadoLibre has it. Anyways, that was a tangent. Sorry about that. The company is predicted to grow, so the quote-unquote copycat of Amazon is predicted to grow at 33%. This is a company that's heavily liked in Latin America. How much am I paying for growth? Not that much, but top tier cheapest. I would argue in my spreadsheet at a 0.32, and the rule of 40 is a 50, which means that this stock is doing well. And I own this stock. I have a full position. I don't plan to add to this one, but I plan to ride it for hopefully another 10 years, maybe more. Who knows? Let me move on to E.l.f. or E.l.f. I pronounce it E.l.f. I don't know how it's pronounced. I think they want people to pronounce it E.l.f., but I'm not so sure. The point that I like about E.l.f. is that this was more than a $200 stock just a few months ago, actually, maybe 8 months ago, something like that, and it went back down, went back to earth, and now the performance for the past 52 weeks is only 4%. So I find that interesting. I like that I'm not paying up compared to last year. So the performance has gone down a little bit, but the revenue growth is still predicted to be 39% next 12 months. The gross margin is excellent at 71%. EBITDA margin is there at 15%. How much am I paying for that growth? Not much, at a 0.9. And the rule of 40 on there is a 54. And E.l.f. is kind of this makeup brand with a lot of digital sales, not purely digital. They do a lot of business at Target in the US, but they have a lot of digital sales. And it's a brand which originally got started with a lot of teenagers, but now these teenagers are not teenagers anymore. Now they are fully grown women, and they keep buying E.l.f. And so that business really worked out. And I would argue E.l.f. is an inexpensive makeup company. So they make inexpensive makeup, but they don't make the cheapest makeup, right? They don't make dollar store makeup. You still feel like you're getting a quality product at a very low cost. So they are kind of the best cost, the best bang for the buck, as we say. They're kind of the best value makeup. Their positioning is there. They're not quite a L'Oreal, which has this vision of being an expensive product, and they're not quite the dollar store makeup. So I think they have a very interesting positioning, especially if we get into a recession, right? I could easily see people upgrade down, I'm going to say upgrade down because you're saving money. So you upgrade down to E.l.f. because the product may resonate more with the younger women than, say, a L'Oreal. And you could also upgrade up. Maybe during a recession, maybe you don't want to go that cheap. You wanna go a little more expensive during a recession. And so this is what economists call the lipstick effect, saying that the last thing that people give up, women give up in a recession is the lipstick effect, and it's understandable because it's the price point, right? If there's a recession, you might be avoiding buying a $1,000 handbag, but you're gonna keep that $19, I don't know, set of makeup, shadow, whatever. You're gonna keep that, I think, and it's an interesting play. So I might be getting into that one, and that would be my second beauty play, believe it or not, because I have another beauty play in the form of Oddity. And Oddity, my investment in Oddity is up, actually. I've been covering that stock when it was down a 0.09 in valuation, down a 0.08. It's been doing well. Oddity, they also have a makeup brand, although more specific in makeup. It's a foundation brand, and so the whole thing that Oddity I was going to say claim to do, but they do it if you read the comments, is they use AI to figure out the shade of the skin, and then they will customize a makeup to the shade of your skin. So while E.l.f. has kind of this best cost type of approach to gaining market share, Oddity has more of an AI type of approach to gaining market share. The companies have a lot of similarities too, in the sense that they are disrupting a business that used to be done through distributors, right? If you bought makeup to L'Oreal, the behemoth, sells to Walmart, to the airport, to Sephora, Macy's, whatever, and then much of the profit is done by, say, a Macy's, for example. That's where all the profit goes. The department store gets all of the profit, right? When you have Oddity or when you have E.l.f., who do you think gets the profit, right? 72% gross margin, 71% gross margin. The profit is received in those cases by the DTC brand, direct-to-consumer brand. Granted, E.l.f. is not entirely direct to consumer because they sell stuff at Target, but Oddity is, well, they have a few stores too, but they sell a bunch of stuff online. Both of these companies have very large portions of online sales, and they don't have long-standing relationships and long contracts with distributors for more than 70 years that would prevent them from undercutting the distributor. So they can undercut their distributor. They are not, quote-unquote, burdened by the distributor that they have to keep happy because the cash cow is the distributor. This is the power of DTC brands. So I like Oddity. I own Oddity. I may not ever build a full position into Oddity if I buy E.l.f. If I buy E.l.f., because I'm still building the Oddity position, if I buy E.l.f., I might decide to have just a half position in E.l.f., just a half position in Oddity, because one position in beauty, I believe, is enough. In my portfolio, that's enough, because it's still not a new trend, right? It's a trend that is well established. I don't think it's going away, but it's not a new trend like AI. It's not a blue ocean. You're not going after a fully new opportunity. Although you could argue with AI and makeup, you could argue that you're doing that. I don't really know. The last one, sector entirely different. In my Patreon spreadsheet, I call these stock like Tidewater, I call them unclassifiable because I can't really classify them. So Tidewater is an offshore service company. They provide services to oil rigs, oil station, offshore oil, you name it. They provide the service. They'll send supplies. They'll bring workers. They'll bring them home. They'll bring repairs. They operate ships to do that, and they have these ships, and these ships, they are able to charge more because a lot of companies just never ordered new ships, and so there is a shortage of servicing ships, and as a result of that, they are able to be predicted to grow at 36% next 12 months. Their gross margin is high, but the EBITDA margin is even more impressive, right? There's not a lot of marketing that goes into selling that service, not a lot of R&D that goes into selling that service, which is why the EBITDA margin and gross margin are very similar here. At 33%, it is my highest EBITDA margin out of the bunch, and they are predicted to grow at 36%. So in absolute, either number is not too extreme, but when you add it up, you get a rule of 40 of 69, and you get an answer to my question, how much am I paying for that growth? You get an answer to the EV over GP over RG question of a 0.19. I find this stock cheap. I have not bought it. I have not pulled the trigger because I am still trying to figure out if the oil business is a business that I want to be in because it is so tied to the price of commodity. It's ever since I've been in the US, I've been hearing that the cost of gas would go up and shoot through the moon. And at the pump the other day, I paid $2.29. Here in Texas, $2.29 a gallon, right? So 3.8 liters, $2.29, whatever. Oil, I'm not sure is a good commodity to be in. We'll see, but there's still a lot of oil out here, and there's still a lot of oil in the world, and so a lot of people are saying oil is gonna go up. I'm not so sure, right? We had a lot of tensions in the Middle East, and oil is not really going up. So, anyways, not a commodity that I want to invest in, but I do like that business, and I'd be much more interested to looking at the cost of the ships and the bet on the cost of these ships. But also, if you follow that field, you know a lot of people have been burnt investing in ships. So holding off for now. I still need to do a full analysis on this one. And these were my 9 stocks, my 9 highest growth cash machines. And of course, the spreadsheet where I do all of this is available on my Patreon if you're interested. This was not financial advice, not investment advice, just entertainment. Please like, please subscribe, follow me on my socials. Thank you for watching.